All right, welcome to the first office hour ever held for F1J1 visa holder on investing. The reason I wanted to do this because I started getting a lot of inquiries from PhD students, from people in academia asking about investing questions and specifically tax treatment, especially if you're going to be non-resident now or in the future or switch status, as somebody sent their questions beforehand mentioned. So we'll try to unwrap some of them, and I noticed that there was a range of different levels of where you are. Some people are already doing investing, some people have started, just want to know the basics. So what I'm going to try to do today is to go through the very specific questions I can answer, and specifically you guys who are already here, so that you get something out of this immediately. And if you have follow-up questions, you can go ahead and type in the chat box. All right, so the first question I'm going to answer is, if an international college student earns $1,000 from a chemist job, can he put that money in a Roth IRA even if that $1,000 may be exempt from tax due to a tax treaty? The student has no other income. Thanks. Okay, so this is regarding whether you even have earned income to put into an IRA. So if you don't already know what an IRA is, it's a tax advantage account in the US. Is for you to save taxes in two ways. So the traditional IRA is for you to get tax deduction right now. And as a lot of non-resident aliens who don't get taxed in the US, you don't necessarily need that. The second way is to do Roth IRA, which is you don't get a tax deduction up front, but you get a tax-free growth for the future. So it's a very good investment vehicle especially for US citizens. But in this case, if the tax treaty deem your income to be non-taxable, meaning that you don't have taxable income, then you cannot contribute to that Roth IRA, because the idea is you only get the tax benefit if you already get the income taxed. If the income has never been taxed, you wouldn't get the tax benefit. The treatment is the same for a US citizens working overseas and get some kind of special tax treatment, and they don't get their income taxed in the US, they also will not be able to contribute to Roth IRA in the US. Okay, so I think that's a easy question for the first one, and I will go on to the next one with people who are already here. Okay. Like I'm missing. Okay. So this question. Okay. So if you're investing in the US while living abroad, is it straightforward to bring money back to where you live if you need it? Okay. So the straightforward question mark from a US tax perspective. So it is straightforward to, if it's in a brokerage account, to sell your investment. If there's a capital gains, you may or may not pay capital gains tax based on tax treaty, but there's normally no reason why you cannot sell the investments, close the account or not, and transfer the money to your country, unless it's a country that has perhaps not so great relationship with the US, where there are some banking regulations. If you think about like Iran for one example, or North Korea for another example. So this is by all means not the complete list. I've heard 12 to 15 countries being thrown around where there will be that kind of very strict restriction that you just cannot directly transfer money between countries. So that would be one consideration. But if your country and the US doesn't have such banking regulations, so the only issue would just be transferring from one financial account to another financial account. Usually we will do it through wire transfer. And the custodians or the financial custodians in the US generally can do that. There may be a fee, and there's normally a fee, and both banks might charge the fee. So the answer is yes, more or less straightforward, but there's cost involved, but usually not that difficult. Okay, so the same person asked, for someone leaving the US, one of the uncertainties about whether to take the money and invest in their home country or leave it in the US and invest here in regards to fluctuation in currency value. How would you recommend going about estimating whether the USA currency will increase or decrease in value over a long period of time relative to one's home country currency? And how does that play into the decision to invest in the US while abroad? So that's a great question. And also, if you know how to answer that question, you will be a, how do I say it, probably a monetary policy expert. There is a basic relationship between the currency exchange rate versus the relative interest each country's monetary agency pays. Like in the US is the Federal Reserve that sets the interest rate. And in your home country, there may be another, your own agency that sets it. There are also a lot of countries that basically peg the US dollar, so that's not even an issue. So if you're in a country where you have free floating currency exchange against US dollars, normally the relationship is if the exchange rate is better for you to send money back home, that means that relatively the interest rate in your home country is not as good as in the US. So there's no free lunch. There's probably a short time frame that you can arbitrage the exchange rate, but normally if you send money back because the exchange rate is better, you can exchange for more. That probably means that in your home country, you can earn less interest versus in the US. But of course, right now it's a strange time where basically almost no country is paying a significant interest. In Europe, you have negative interest. And the US is still, like in a high yield savings account, you can still earn 1%. So it is still some interest. So that's how I look at that information. But like you said, in the long run, it's really not something you can arbitrage against. So normally I would say that it doesn't necessarily impact short-term investment decisions. In fact, if you want to smooth the overall, if you are able to keep the account open for a long time, and you want to keep the account in the US for a long time, but you want to periodically send money home, I would recommend doing periodic rather than try to gain consistency if there is a time where you can sell everything and send back home. Okay. Next up. Does that answer the question? Okay. So next person. Okay. My girlfriend is here on an F1 visa from France and wants to start investing. If she were to open a brokerage or a retirement account and leaves the US in 5 years, when she withdraws the money, will she pay taxes to both the US and her new residence? So this question is sort of, it depends. The depends is on whether the new residence is France, or maybe because if you're EU resident, you choose to go to another EU country. The US tax treaty works in a way where it's between two countries, so it's not between US and the EU. So obviously there will be differences. So the depends part is the tax treaty. So the tax treaty usually will handle where you pay taxes. So normally, as a non-resident, I would say the answer is actually no, that you will not pay in both the US and the new resident. In fact, you may be able to pay zero in both the US and the new residents. The reason is because in the US, if you're a non-resident, so you have the capital gains that you never cashed out and you moved overseas and you kept the account open. when you sell your investment as a non-resident, the capital gains tax rate can be 0 if there's no tax treaty between your residency country and US. So in that case, it's assuming that you will be taxed in your new resident country, but there are also many different countries in the world where capital gains tax rate is free for its resident. So you could find a perfect time and place where you can actually pay no taxes on your capital gains. So I hope that's the answer you want to hear. So if people are interested in the list of all the tax treaties, I'm leaving the link in the chat box here. So I think that answered that question. You're welcome to ask follow-up questions. Let's see next if I have. Okay. As a J1 visa holder, I will change the status from non-resident to resident next year, and then to non-resident again when leaving the country. Still, I pay full taxes in the US. Are there things to respect when holding stocks? Okay, so I guess in general, I mean, you're holding the investment in the same account as long as you're staying in the US. So in terms of how the account looks, it will be exactly the same. The main difference will be the taxation, which is dictated by a tax withholding form that a custodian need to send to the IRS. Or they keep that withholding form, but they withhold your taxes according to the form, which is WABEN for non-tax resident. So right now, if you're still a non-resident and if you open an account and you indicated that, the custodian will ask for the form W8BEN. And it's pretty straightforward. You just need to fill it out and say that you're certified that you're non-resident and see if you can claim treaty tax rate. So depending on where you came from, you might be able to claim lower treaty tax rate for dividend. So for no tax treaty, for non-resident, it's 30% withholding. But if there's a tax treaty that said withholding is less or it's tax-free in the US, then there would be no withholding. So in the next year, if you're still in the US, but now the non-resident status doesn't work anymore and IRS require you to start filing as resident, what you will have to do is then contact the custodian and basically switch your status. So it's not as complicated as going to USCIS to switch your status or your visa status. It's more just finding the right customer service person to say that now you are no longer non-resident, and they will request the proof, obviously. So you might send in your current visa. If the visa is the same, then you might need to just send them the relevant place where you have to start filing resident, either on the treaty or on just a normal IRS website saying after 2 years, I need to start filing as resident. So please withhold as resident. And they might have another form for you to fill out, but that should be straightforward. And the same thing applies if you then leave the US and the next year when you're filing tax return, because for that, well, actually think about the year after you leave the US, you will be filing taxes for the previous year when you're still a resident. So you'll actually be filing as a resident, but any action you take for the year that you're no longer in the US, you will then be a non-resident. So the sort of the 0% capital gains tax rate like I talked about and the 30% dividend withholding rate like I talked about will apply. So you also need to then go back to custodian to resubmit the W8BEN and maybe show a cancellation of visa or something, depending on what they're looking for. All right. So here's the W8BEN, but usually the custodian will send you something called a substitute W8BEN. So you will just fill it out as you open the account. Or if your account is already open, then just request that form. Okay, hope that answered that question. Let me see. Okay, so I think the rest of the questions for the people who are currently here are more general. So when I say general, is that it's more like, how do I start investing? Or what's the difference between doing a 401k IRA or a normal brokerage account? How do I think about which one to use? So I can perhaps, so it won't be a straightforward answer, but we can sort of go through the steps if the people here think that's useful. Can tell me. Okay. So I know that the US stock market is interesting. So it has gone on up, right, since 2010 or 2009 until the pandemic hit. It has been going up straight line. And so you probably hear a lot of people, in the last few years, they finally get over the last crisis in 2008 and 2009 and start really going back to the market, which also fueled the market growth. And then most recently, the pandemic hit. So in about a month, the market, I think, dropped 20 to 30%. But also, since April, the market has returned 20 to 30%, actually now back to more than where it was a year ago. So in this kind of volatility, it is kind of difficult for you to think about investing when you think about a short time frame. So I think that's one of the major questions I've heard from students. When you think about it, it's like a limited time frame. If you know for sure you cannot keep the account open, then making an investment sounds really risky. And I totally agree. If you already know you're going back to a country where it's very not friendly with having some kind of US account or having bank transaction with a US bank or financial institutions, or maybe there's some other consideration like you're moving back home and you likely will buy a house, or you're moving back home and there are better use of your capital, then perhaps think about just not investing in the US. So of course, you should keep saving, and keep saving is great. So it's not to tell you to stop, saving money and spend all of it. So you will continue to save and invest, but you can do it in two ways. One, if you have, let's say your program finishes in 2-3 years, and you're definitely not staying in the US, and you definitely cannot keep the account open because your home country's relationship with the US, then simply save US dollars in cash, and you can take it with you when you leave. Or you can start making transfer exchange, sending it back to your home country. And if there are investment opportunity back in your home country, then great, you can invest that way. There's no reason why you necessarily have to invest in the US or through a US account. Of course, there are a lot of benefits of doing that. But if it's actually creating headaches or trouble for you because of what that country is or what you want to do in the future, then don't feel the pressure to invest in the US. You also have the advantage because as a US citizen, if a US citizen want to invest directly in an overseas account, it actually make their tax reporting very complicated. But if you're a non-resident still under F1 or J1 visa, you don't have to report your foreign income on the US tax return. So that makes it really easy. So just one thing to remind you, if you are a F1 or J1 visa holder, but you're already filing as a resident, then make sure you don't invest overseas because that makes your US tax return very complicated. Okay. The next step would be, okay, so we determined that you have money to invest, you've saved, and there's no reason that you cannot keep the account open. Right now you can open an account, and you check the custodian that they serve somebody in your home country. So if you go home, they will keep the account open. So all of that is true. Then you get to the next step, which is whether to do brokerage or an IRA. And I mentioned a little bit before, IRAs were tax advantage. So of course there can still be tax advantage even if you are paying taxes as a non-resident in the US. And of course, your peers, the US citizens, they will say, well, Roth IRA is the best, it's tax-free forever. But we also talked a little bit earlier about if you're a non-resident, you also don't pay capital gain tax in the future if you're a non-resident when you sell. So in terms of, if you're thinking about, oh, I invested in Amazon when it was $500, now it's $2,000, then all of that gain, you can still not pay any taxes in the US. So using a Roth IRA doesn't really give you much more other than the dividend part. So the dividend part is the one that has a mandatory 30% withholding if there's no tax treaty. However, you're going back to Amazon doesn't pay the dividend. So in a sense that you also don't get punished by doing that. So that's just an example. I'm not saying to buy 100% of your portfolio in Amazon or Microsoft or Apple, the companies that have grown so much. Just give you an example that how, as a non-resident, there are actually tax benefit of investing in the US already. You don't necessarily have to be so focused on, I need to use an IRA, but I'm not even sure if my income qualifies, and just stops you from investing altogether. If you don't have time to investigate tax treaty between US and the country you might go to in the future, then I would suggest just go ahead and open a brokerage account and start investing, and don't let the tax implication stop you from doing anything. So that's, I would say that's the second step. The first step talk about is making sure it's not going to be difficult for you to extract yourself because the specific country you're going to. The second is if you can keep the account open for a longer time frame so you can endure the volatility instead of hoping that the market doesn't go down in 2-3 years and you cannot recuperate when you leave, then investing in US is a pretty good idea. And it's a pretty good idea, not just because the US stocks or the markets per se, it's because the US infrastructure. The infrastructure in the US make investing directly in the public share markets very cheap. So if you open a custodial account, or if you probably see a lot of ads online saying $0 trade, meaning you can use their platform to buy stocks and sell stocks. There's no commission, you don't pay the platform. So it's not the case for most of the countries in the world. There's usually commission, and up to probably 6 months ago, it's the same in the US, there is commission. So now it's no longer an issue, it's actually make trading easier. And second is the type of investment product that's available. So if you're not sure which stocks to pick, most of the time I would suggest you would be investing in a holistic way. You would just invest in the entire market through an index fund. That means a mutual fund company or ETF, exchange traded fund company, they would gather a whole bunch of people's money and they will buy basically not all the companies, but pretty close of the companies that represent the entire public markets to track a certain index. So you probably hear a lot about the S&P 500. That just means it's the 500 largest company that makes the S&P companies list of what their index is. So you will be able to buy, even if you only have $100 or $1,000, you can buy a share or a few shares of the S&P 500 index ETF or index mutual funds. That allows you to have access to all the 500 companies at once, instead of each company, like Amazon, one share is right now close to $2,000. You need $2,000 to buy one share. So that's another reason that the US is easy to diversify into many different public companies when you only have very little to invest. There's also a new technology. It's even new for US persons who's been investing, meaning fractional shares, meaning you can actually, like I said, Amazon can be costing $2,000. And right now you can actually say, I just want to buy $100 worth of Amazon, and you will own 100 over 2,000, the fraction of the one share. So that's a fairly new innovation, but it's just something that you can also do if you have very little in it to invest. So this is all to say that you're actually on the right train wagon, that it's good to have the opportunity to start investing while in the US, when it's relatively easy to open an account when you are in the US. So, okay. I'm going to stop right here, and I guess I see two questions. Okay, first one, can you continue contributing to your investments while living outside of the country? My understanding is yes. So this is the reason. So there are actually, if you go to these custodians' website, I think depending on where you came to me, you might have heard me talk about certain custodians like TD Ameritrade or Interactive Brokers, which are two major ones that are pretty friendly and actually specifically targeting people living overseas to open accounts to trade US stocks or ETFs. So if you think about, if you're just moving overseas without getting a green card or anything, so you just give up your visa, move back home, you will be at the exact same situation as those people that these custodians are targeting, like a non-US person, never set foot in the US, but they can open an account in the US and trade. So I don't think that's an issue. It is an issue for US citizens who move overseas, and they're under separate regulations. So that you might have heard about that as well. Okay. Next. Do you recommend buying index funds through Robinhood? So Robinhood is a custodian like any other. So I don't have anything against Robinhood if you already have an account open. I've heard contradictory message on whether Robinhood actually allows a resident to open an account. So I'm not sure, but if you're already filing taxes as a resident, then that shouldn't be an issue. Okay. Is Fidelity Visa friendly, or do you recommend using a different broker? I have heard that Fidelity, I think their policy changed over time. So in the last perhaps 5 to 10 years, I've heard different versions. A lot of it regarding they no longer want to work with US citizens living overseas. I never seen Fidelity actively going after non-residents, meaning, like I said, people like your family who don't come to the US and they just live overseas. So they may accommodate you, but I'm not sure. So whenever you have questions regarding whether certain custodians would do this, or is this custodian will do this, that the only way to ascertain that at any given moment is call customer service. And you don't have to give your account number or name if you're afraid that they're going to close your account or stop talking to you. Just post hypothetical question that, either you already have the account open, you have not an account open, you might move overseas, what your visa status, will you continue to be a US tax person or you won't be? And they usually will tell you, they will ask some question probably where you're going to be, and they will likely tell you whether they want to do business with you. Okay. For 401k, how would you compare target date fund with special situation fund that has a broad mix of assets? Okay, I'm not sure what the special situation fund means. So the target date fund normally it's already a mix, like if you're talking about has a mix of assets, target date fund also has a mix of assets. The main difference is target date funds, usually the main date is that it's based on when you need the money. So if you say target date 2050, meaning your retirement date, or even if you don't want to retire, but that's the time you want to start pulling the money out. That's how they manage the risk profile of that particular fund. So if it's 2050, most likely it will still have 85 to 90% in stock, because right now it's only 2020. So you have 30 years for the market to grow and endure the volatility in between. If you're talking about a 2030 fund, most likely will have a lot more in bonds, at least 20-30%, I would think. So it has to do with your risk tolerance, and you don't have to select your own investment fund. So I would say that's the easiest solution if you don't have the time to do research, or pay for an advisor to look over it for you, or try to figure out exactly what the differences are. Then target date fund usually is not a bad choice, especially if you're starting with small balance. Can you edit a target date? No. So usually target date fund is a established fund. They will give you some options depending on, I guess if your company only have, or your school only have young people, or all of your professors are under 40 years old, maybe they only give you, longer range target date fund. But most of the time, what I've seen is you will have, right now, you probably have a 2025 to 2060. So, and it's usually every 5 years. So it's 2025, 2030, 2035, 2040. But you can switch between the funds anytime if you think your retirement day will change. Okay. I got the impression that if you live in the US but file non-resident US tax return, your capital gains rate is 30%. If you live outside the US and you are non-resident, then your capital gains rate is 0. Is that correct? Yes, that is correct. And that's without tax treaty. So if you want to get, you think the market is at a height, but you might be moving, in 1 month, then perhaps it will help to sell after you move. But the thing is, it's all based on tax year. So you also need to make sure it's not just, sell the day after you move. You might be still in the same tax year, and it will count towards the time that you're in the US. So you'll have different ways of filing, whether you can file part year or full year, but need to make sure to take that into account. Okay. How do you feel taxes when you are on a student visa and have investments? Do custodians automatically provide the necessary tax forms? The custodian will send you 1099 for sure. Because 1099 simply just noting how much, for example, how much tax withholding they've taken from your dividend. If you never sold, but you invest in an ETF that pays you $100 dividend last year, then you should get a 1099 div, says you have dividend. Then you will report it on your 1040 NR, there should be a line to report passive or investment income, and that's where you will report. And because the withholding is already made, you will also want to put withholding as a tax payment that's already made. Like kind of like if you have a TA job that some of the taxes already withheld, and you will include that so you don't get taxed again. Okay. With tax treaty, how does it work again? Missed it. With tax treaty, it really works country by country basis. So you need to go to see how your country works in terms of which country has the right to tax. Because if you're considered a non-resident, that means your home country has the right to tax. But it can also say the home country has the right to tax and your home country tax it at 0%. So you just need to read the relevant section. There is a, some of you might already seen this. So this is specifically a tax guide for F1J1 visa holder, and it has sort of summary of tax treaty sections on income tax. That might be helpful. Do you encourage students to open a high yield savings account? If so, any recommendation? Yes, there's no reason not to, unless they specifically, when you go through the application, you do need to read the disclosures and check the right check mark. If they ask you, are you a U.S. tax resident, and you cannot check yes, and they won't let you open an account, then you can't. So that's the only issue I can think of. If the online high yield savings account application, we go through it, it doesn't so prevent you from doing that. There's no reason not to. Okay. Okay. You might need to just kind of rephrase the entire question for me, because I'm kind of lost in which question you're referring to. I saw a few people joined that I haven't answered their question, so I'm going to do that, and we have about 5 minutes left. So, okay. Okay, so one person that has a specific question, let me see. Okay. If I start to investing on Roth IRA in the US now and end up leaving US and back to my home country, is it more wise to keep it in the account or withdraw it out? So it depends. We talked a little bit about tax treaty, and so sometimes, in very few instances, Roth IRA is covered in tax treaty, most of the time not. So it could be that Roth IRA is considered not an account, and that's tax-free in your home country, most likely not. So even though it's avoiding tax in the US, both on capital gains and dividends, you need to report it once you go back to your home country. So it could be a good idea to not deal with that, but also there may be benefit to keep in the US depending on your personal circumstance. So I think there's too many things to think about there, but maybe this will help. It's a link about Roth IRA. Okay. Is dividend income considered passive income? Yes, it is. Well, it's getting really dark because it's now raining really hard where I am right now. I just noticed that suddenly, I hope everybody can still see me. Okay. Yeah, so answer your question. Yes, dividend income is considered passive income. So you do, I think somebody asked that question before, you do have to report on your 1040 NR if you're filing as a non-resident. So there is a field where you can report, but most likely if you have fill out your WABN correctly, the custodian has withheld 30% on the dividend already. So you will need to also fill that out saying you already paid a certain amount of tax, and so you don't get taxed again. All right, have I missed anybody's question? Okay, I just saw one, several actually. So I'm going to answer the ones that are already in the chat box for now. Okay. Could you give again the names of the custodians that are targeting foreign people to invest in US? Yes, it's TD, Ameritrade, and Interactive Brokers. Oops, I think I only wrote privately. I'm going to do it to everyone. Okay. Is the 5-year benchmark of non-resident to resident switch cumulative? For example, if someone stayed in the US for 5 years, out for 2 years, then come back again with a 5-year restart, my understanding is it doesn't. So there is a form where you will certify the number of years you've claimed that special. It's not called an exemption, but it's special count as a non-resident. So that basically it's continuous. Sorry, not continuous. Basically, it's a number of years you've claimed. How important is it for F1 student to have SSN when trying to open a brokerage account? If you don't have SSN, most likely you need to have a tax ID. It will make opening an account easier. So it's an ITIN, which you can apply. Okay, I'm going to temporarily stop recording and turn on the light because it's really dark. Okay, I'm back. So we'll answer the last 2 questions, and now it's 3:45. So what about E-Trade? I actually just have somebody reach out to me, a non-resident, saying that he contacted E-Trade about potentially leaving the US next year and what they would do. And E-Trade told him that he will need to close the account. So I don't know if it's country-specific situation, but you would need to contact them directly. Okay. Okay, so the last question, open Roth IRA. In the future, if I return back to my original country, should I also need to pay taxes for my own country? Most likely, yes. So Roth IRA, I mentioned a little bit before, Roth IRA is one of the accounts, because it's new in the US, it only started in the 90s, I believe, that a lot of treaties didn't even take that into account as a potential an account that they need to negotiate about because the specialness tax treatment of it. So it's very likely your treaty doesn't recognize that particular account, meaning that account may be taxable. It's the same as a normal brokerage account, but it also really depends on whether in your home country they even tax foreign investments, or do you, how do they tax the foreign investments? Do they tax capital gains? Do they only tax when you sell, or do they tax over time, or do they tax when you remit the money back in country? So there are many different possibilities. So that's why this field is so fascinating, because every 2 country pairs different rules. All right, I think I have attempt to answer all the questions for everyone who's on the call today. Did I miss anyone? All right. Well, thank you very much for joining me today. And I hope this helps. And let me know if you have the need for future office hours like this. If you hear from your friends, colleagues that this will be helpful, I will consider holding more of these in the future. All right. Take care, everybody.